Welcome back, everyone, to the Deep Dive. Today, we're really getting into something quite fascinating, a real puzzle, financially and technologically. We're looking at QuantumScape Corporation. You probably know them, ticker QS.
Right. They're right there on the bleeding edge of solid-state battery tech. And they've just dropped their Q3 2025 earnings.
And this isn't going to be your typical earnings call breakdown, is it?
No, definitely not. I mean, when you look at a company like QuantumScape, you have to remember what they are. They're basically a pre-revenue development stage science project in a way.
Right.
So, forget your standard metrics, profit margins, revenue growth. They just don't apply yet. If you just look at the official GAAP loss, you're missing, well, almost everything that matters.
Okay, so that's our mission today then. To cut through all that complexity, we're going to use a pretty structured approach, a 5-part framework we've developed, really designed for these kinds of, let's call them speculative tech plays. We need to blend their actual operational progress, the science, the breakthroughs, with what the market was actually thinking, what it expected.
And crucially, how they're managing that cash.
Yeah.
Runway.
Exactly. And that market reaction. That's really the headline for this quarter, isn't it?
It really is. You, the listener, really need to grapple with this central, paradox that played out.
Yeah.
QuantumScape technically beat the Wall Street estimates on the bottom line. They hit some significant operational milestones, too.
Yeah.
And yet, boom, the stock just tanked. A sharp double-digit sell-off right after the announcement.
How does that even happen? You do everything right inside the company, hit your marks, and the market just punishes you.
That's exactly what we need to unpack.
So we're going to walk through this structure slide by slide, really focusing on what matters most here. Cost control, obviously, the health of their balance sheet, that cash runway we mentioned.
And the real steps, the tangible progress towards actually making these batteries a commercial product someday.
All right, let's get started then. #tag now for slide 1. The at-a-glance scorecard. Okay, slide 1. The scorecard. Since QuantumScape, as we said, is pre-revenue, our focus immediately snaps away from income. It's all about managing expenses.
Right.
So we look at net loss, loss per share. And if you just look at how they're doing internally, operationally, the numbers actually show some pretty clear improvement.
Oh, they absolutely do. The reported net loss attributable to common stockholders for Q3 2025, it came in at about negative $105.8 million.
Still a big number, obviously.
A very big number, yes. But the key is always the comparison, right? Year over year. And that figure is actually an 11.5% improvement, meaning the loss was smaller than the negative $119.6 million they reported back in Q3 2024.
Okay, so that points towards better cost control, management tightening the belt over the last year.
Precisely. It signals that commitment to internal efficiency.
And that efficiency gain, it flowed right down to the per share number 2, didn't it?
It did. They reported a diluted loss per share of negative 18 cents.
Which is way better than last year.
Yeah, a really substantial improvement, actually. 21.7% better than the negative 23 cents per share loss they had in the same quarter last year. So yeah, if you look at those numbers just by themselves in a vacuum.
Strong signals.
Fiscal discipline.
Exactly. But this brings us to something really important. A crucial learning nugget, maybe, for anyone analyzing these high-flying tech stocks. We're focusing specifically on diluted EPS. And we need to understand what that really means for a company like QuantumScape.
Okay, yeah, let's unpack that. Why is diluted EPS the number everyone uses for comparison here? What makes it more, conservative or realistic than just basic EPS?
Okay, so basic EPS is super simple, right? It's just the net loss divided by the number of shares actually out there trading right now.
Got it.
Diluted EPS, that's more of a forward-looking kind of worst-case scenario check. It makes an assumption. It assumes that every single stock option, every warrant, every convertible security that could potentially become a share.
It assumes they all do become shares.
Yeah.
Exactly. So you take that same net loss, but you divide it by a much bigger theoretical number of shares, the fully diluted count.
So it's painting a picture of future reality, or at least future risk, baked into the current structure.
Precisely. And for these development stage tech companies, the ones that lure top scientists with stock options instead of huge cash salaries.
Actually common.
Very common. The gap between basic and diluted EPS can be massive. So the diluted number forces you, the investor, to account for that future shareholder dilution that's kind of built into how they pay their people. It's just the more realistic, long-term view of value per share.
Okay, that makes sense. And based on that critical diluted EPS figure, QuantumScape did technically squeak out that beat Wall Street wanted. Revenue was $0. No surprise there. perfectly matched the $0 consensus.
Yeah.
But that reported diluted EPS negative 18 cents. It just edged out the consensus estimate.
Right. The consensus was also around negative 18 cents, maybe slightly worse depending on the source, like Zacks or NASDAQ data confirmed. So it was a tiny beat, but technically a beat. They lost slightly less money than the analysts modeled.
And sometimes even the smallest fraction matters in this game.
Oh, absolutely.
Which brings us right back to that paradox. We've got operational improvement, check. We've got a technical beat on the bottom line, check. And yet, the stock still got hammered. Dropped about 13.8% on October 22nd, the day of the announcement. Why? It just feels wrong, counterintuitive.
Yeah, this is where the internal execution story crashes into the external valuation reality. The implication here is pretty clear. Investors had already priced in, well, not just progress, but potentially years of future success. You have to remember, QS stock had been on an absolute tear leading up to this report, up over 200% year to date at one point.
Wow, okay, so expectations were incredibly high.
Stratospheric? The market wasn't just looking for incremental steps forward. They weren't looking for just hitting the plan. They were looking for something big, a major de-risking event.
And by de-risking event, you mean something huge, like final proof of concept on a next-gen cell with amazing cycle life, or maybe signing some massive exclusive supply deal with a car maker outside their existing partners.
Exactly that kind of thing.
Yeah.
Something that fundamentally changes the risk profile. So when the company delivered, solid incremental progress, shipping new samples, managing costs well, things they said they'd do but didn't deliver that bombshell news.
The market took its profits.
That's right. The high valuation just couldn't hold up based on only hitting the existing plan. People saw it as an opportunity to lock in gains. And analysts afterwards kind of confirmed this view. The chatter wasn't really about the technical wins as much as it was about the huge amount of money still needed down the road and that premium valuation. Caution just won out.
So it's a classic case, really. They managed the execution risk well, but the valuation risk came back to bite them.
Dominated the narrative, yeah.
Hashtag. Moving to slide 2. The engine of profitability.
Okay, slide 2. Profitability, or rather the engine of profitability, since there aren't any profits yet.
Right. No revenue, so it's all about expenses and cash burn. This is what determines how long they can keep the lights on, how long their runway is.
Exactly. And this slide really shows where that beat on the bottom line actually came from. It wasn't magic, it was cost control.
And it looks pretty impressive, actually. Total operating expenses, down 11.6% compared to last year, dropped to $115 million. That's the main reason the net loss shrunk.
That's the core driver, yes.
Yeah.
But we need to look inside that number, see where they cut. Because for a company whose entire existence depends on R&D, cutting costs is, well, it's a tightrope walk. You cut too much in the wrong place.
And kill the future.
Precisely. But it looks like they navigated that really well. Let's break down the spending. Research and development, R&D, that's the heart of it all, right? Investing in the battery tech itself. That came in at $92.1 million. Now, that was a decrease from Q3 2024's $97 million, but only a modest one. A strategic trim, perhaps?
Okay, so they didn't slash R&D. They kept the commitment to innovation pretty much intact.
Near constant, yeah. A high level of commitment to the main mission. The science, the breakthroughs, they definitely didn't starve the engine.
Okay, so if R&D stayed relatively flat, where did the big savings come from? How did total OPEX drop almost 12%?
That came from general and administrative expenses, G&A.
The overhead, corporate stuff, legal, admin salaries.
Exactly. That saw a huge reduction, down 31.0% year over year, dropping to just $22.9 million.
31%. Wow.
Yeah. That sharp drop is real evidence of disciplined overhead management. They basically protected the R&D budget by taking a serious knife to the corporate overhead, preserving capital for the main mission.
Okay, a 31% cut in G&A is definitely significant. It saves cash, no doubt. But playing devil's advocate here, could a cut that deep signal something else? Like maybe a lack of confidence in scaling up soon? Are they potentially slowing down hiring for roles they'll need later or delaying getting ready for a big commercial launch?
That's a really sharp question, and it's valid. For most companies, yeah, a 31% G&A cut might look like a distress signal.
Right.
But for a company like QuantumScape, a pre-revenue R&D shop, it probably signals a strategic choice. Every single dollar they spend outside the lab
is a dollar not spent on the science.
Exactly. So by slashing G&A, they're arguably signaling that their priority right now is long-term survival and getting the tech right. It's about extending that runway. It suggests their focus is laser sharp on the lab, on the pilot plant, not on building out, say, a massive sales team just yet.
Okay.
It's a trade-off. And it seems like one they felt was necessary to keep the core mission funded for longer.
That makes sense. That distinction is really key. Now, let's go even deeper. Let's look at the difference between that official accounting loss and what they're actually burning in cash, the whole GAAP versus non-GAAP thing. This is often where you find the real story, isn't it?
Oh, absolutely fundamental, especially for understanding tech companies that use a lot of stock options. So the GAAP net loss, that official minus 105.8 million number, that includes some pretty big non-cash charges, things that hit the books but don't actually involve cash going out the door this quarter.
Right.
So management provides another metric, adjusted EBITDA loss. That's their view of operational performance without those non-cash items muddying the waters. And for Q3, their adjusted EBITDA loss was only negative $61.4 million.
Whoa, hold on. That's a huge difference. Over $44 million less than the GAAP loss.
It's enormous, and it highlights the difference between accounting rules and actual cash flow.
So what are the main culprits? What are the big non-cash charges inflating that gap number? There must be a couple of key ones.
There are two main ones typically. First, and usually the biggest for companies like this, is stock-based compensation. That was $29.2 million this quarter.
Okay, so that's the accounting value of the stock options and awards they give to employees.
Exactly. It's an expense on the books, crucial for attracting and keeping talent, especially top scientists. But no actual cash leaves the company's bank account when those options are granted or expensed. It's an internal mechanism.
Makes sense. And the second big one?
Depreciation and amortization. That totaled $23.7 million. This is basically the accounting write-down of all their expensive gear, the R&D equipment, the manufacturing lines they're building, the test beds, the lab infrastructure.
Stuff they already paid for, presumably.
Right. They paid for it in the past, but accounting rules make them spread that cost out over the equipment's useful life. So it's a real expense reflecting asset usage, but again, it's not cash flowing out this quarter.
So the big insight here is that QuantumScape's actual cash operating loss is way smaller, almost 40% smaller than the headline accounting loss suggests.
Exactly. It's not some accounting trick. It shows really strategic capital allocation. They're minimizing the cash they're actually burning through each quarter while still funding this massive world-class R&D effort.
And that superior cash management, that discipline, is really why they were able to slightly beat those market expectations on the bottom line.
That's the connection right there.
Hashtag now for slide 3, financial strength and shareholder rewards.
Okay, slide 3, financial strength. Now, we've kind of hinted at this, but for a company that's still years away from selling anything, the balance sheet, the liquidity position, these are everything.
Forget the daily stock swings for a minute. This is about survival, right?
Yeah.
Will they be around long enough to actually deliver on the science?
That's the billion-dollar question, literally. So let's look at the balance sheet structure first. As of the end of September 2025, total assets were sitting at $1.34 billion.
Okay.
And that absolutely dwarfed total liabilities, which were only $127.5 million. So you do the math, total stockholders' equity was really robust, about $1.22 billion.
That sounds incredibly strong on the surface. Assets vastly outweighing liabilities.
It is. And what's really foundational here, digging a bit deeper, is the debt-to-equity ratio. You divide those total liabilities by the total equity, and you get an incredibly low ratio, around 0.10.
0.10, that's tiny.
It's tiny. What it means, in simple terms, is that the company is almost entirely financed by equity money raised from shareholders rather than by borrowing money and paying interest.
And why is that low debt load so critical for a company like QS with this long, uncertain R&D path ahead?
Because debt comes with strings attached, specifically scheduled mandatory interest payments and maybe principal payments too.
Right. Things you have to pay, whether you're making money or not.
Exactly. For a company with zero revenue, servicing debt becomes this huge, suffocating risk. What if you hit a scientific snag? What if development takes longer? Debt payments don't wait.
So being mostly equity finance removes that pressure.
Completely. It removes the pressure from debt holders breathing down their neck, removes the immediate threat of insolvency if things get tight. This low debt ratio effectively buys management the most valuable thing they can have.
Time.
Time, exactly. It lets them focus purely on the science, on solving these incredibly hard battery problems, instead of constantly worrying about making the next interest payment.
Okay, that stability focus leads us right into liquidity and the cash runway. And this This was arguably the biggest piece of solid good news in the whole report, wasn't it? A real de-risking event for their long-term prospects.
Oh, absolutely huge. What was their cash position at the end of the quarter?
They were holding a cool $1.0 billion in cash, cash equivalents, and marketable securities. $1 billion.
A fortress balance sheet, basically.
And the guidance they gave based on that cash, that was the real shocker in a good way.
It was startlingly strong, yeah. Management came out and said that this current level of cash, this $1 billion, is projected to fund the company's operations. Wait for it. Through the end of the decade.
The end of the decade. That's 5+ years from late 2025.
And if you connect the dots, that's a significant extension compared to what they were guiding before. Maybe a full 12 months longer.
Wow.
In this high-risk, high-burn world of next-gen battery development, telling the market you've got enough cash for potentially 5, 6, 7 years, that just wipes away a massive chunk of investor anxiety about near-term funding needs. It's a huge structural advantage.
Okay, that sounds amazing. A decade of runway. Fantastic.
Right.
But hang on, that $1 billion didn't just fall out of the sky.
No, it certainly did not.
It came at a cost. And that cost has a name.
Yeah.
Dilution. We have to talk about the shareholder trade-off here, don't we?
Absolutely have to. QuantumScape, as we established, isn't funding itself with debt or revenue. It relies on raising capital by selling shares, equity. And the price of achieving that incredible stability, that decade-long runway, well, it's reflected directly in the number of shares outstanding. The weighted average number of common shares, it increased by 15.7% compared to the same quarter last year.
15.7%. In 1 year.
Yeah.
That's a lot of new shares flooding the market.
It's a substantial increase in dilution, yes. Went from about 509 million shares to nearly 589 million shares year over year.
Okay. And how did they explain that? Where did all those new shares come from?
They attributed it mainly to the completion of their at-the-market equity program, often called an ATM program.
Right, I've heard of those. That's where they can sort of trickle shares into the market over time, right? Not one big offering.
Exactly. It's a more flexible, arguably less disruptive way to raise capital compared to a single large secondary offering that can often tank the stock price temporarily. They can sell shares incrementally when market conditions seem favorable.
So it's a disciplined approach to dilution, maybe.
You could call it that, strategically disciplined. But discipline doesn't change the math. That 15.7% increase still represents a very real reduction in the ownership percentage for every single existing shareholder. Your slice of the pie got smaller.
Okay, so there it is. The clear, complex trade-off. They secured this incredible decade-long runway, which massively de-risks the operational future. But they did it at the direct calculable cost of diluting existing owners by almost 16%. How should you, the listener, think about weighing that? Is it good or bad?
Well, it really depends on your perspective, your investment horizon. If you're a short-term trader, dilution is almost always seen as negative. It puts downward pressure on the price, makes it harder for the stock to rise.
Right.
But if you're a long-term believer, someone betting purely on the technology eventually winning out years down the road, then that decade-long runway might be the most important thing.
Because it ensures they actually survive long enough to finish the R&D.
Precisely. From that perspective, you basically paid a 15.7% fee this year in the form of dilution to ensure the company has the cash it needs to survive and potentially cross the finish line. It's sort of a necessary evil when you're financing something this revolutionary, this capital-intensive.
#now for slide 4. The road ahead management's outlook and key takeaways. All right, slide 4. We've looked at the money, the balance sheet. Now let's pivot to strategic execution.
The actual progress they're making towards getting these batteries out of the lab and into, well, eventually into cars. This is where the science happens. What were the key technical wins management was highlighting this quarter?
Okay, so the big one, the headline achievement, was hitting a key goal they set for 2025. They successfully began shipping their Cobra-based QSE-5B1 samples in Q3.
Okay, Cobra-based QSE-5B1. Let's break that down. What does that actually mean?
Right, so QSE-5, that refers to a specific design or generation of their solid-state cell, Cobra-based, that indicates it uses their latest, most advanced proprietary cell architecture in the B1 designation. That usually suggests it's a slightly larger format, maybe a second iteration, built specifically for partners to test. It's a step up from earlier, smaller A samples.
Great, so shipping B1 samples. Why is that a significant step? What does it prove? It's really about tangible progress. It shows they can produce the technology not just in tiny lab cells, but in a format that's closer to what might actually go into a battery pack. It helps de-risk the manufacturing and performance at a more relevant scale.
So these aren't for sale, they're for testing.
Exactly. These are validation tools. They go out to their automotive partners who then put them through the ringer, testing the cell's durability, its cycle life, its power, its safety under conditions that mimic real-world driving.
And while they're shipping these samples, they're also building out the factory, right?
Yes, in parallel. They mentioned continuing to install the more sophisticated, higher volume production equipment for their pilot facility. They call it the Eagle Line.
Eagle Line.
This is the infrastructure that's meant to bridge the gap between lab-scale production and something closer to pre-pilot, potentially higher volume manufacturing readiness down the line. It's about learning how to build these things consistently and efficiently.
Got it. So progress in the lab, progress on the pilot line. What about outside the company? Commercial engagement. It's not enough for the batteries to just work, right? Car companies have to want them.
Absolutely critical. And the ecosystem seems to be expanding, which is a really positive sign.
Okay.
We saw that very public launch event with their cornerstone partner, the VW Group. They showcased a Ducati V21L electric motorcycle using QuantumScape's battery technology.
Right, the electric race bike. That got some headlines.
It did, and it's huge external validation, right? Showing the tech performing in a demanding, high-visibility application. But perhaps even more intriguing was the news that they're now in active engagement with a new top 10 global automotive OEM.
Ooh, okay. A new top 10 OEM. They didn't name names, I assume.
No, kept it vague. But that's still fascinating. Why? Because it shows they're actively looking beyond just VW.
Diversification. Reducing reliance on just one major partner.
Exactly. Relying solely on VW, while great initially, always carried concentration risk. If VW's plans changed, QS could be in trouble. So getting serious interest, active engagement from another major global player, could be American, could be Asian, is huge validation.
It proves the technology itself is attracting broad interest across the industry.
Right. It reinforces that narrative that this isn't just a VW science project, it's potentially industry-disrupting tech that multiple serious players are looking at, even if we don't know who it is yet.
Okay, very interesting. And that engagement, that partner activity, ties into a sort of strategic pivot management made this quarter, doesn't it? Introducing this new metric, customer billings.
Yes, this was really interesting. They reported $12.8 million in customer billings for Q3.
Which sounds like revenue, but it's not quite revenue, is it?
It is absolutely not GAAP revenue. Let's be crystal clear on that.
Okay, so what is it then? Why introduce this number?
It seems like a deliberate attempt to build what you might call a bridge narrative, a way to show financial traction before they have actual product sales that qualify as revenue under standard accounting rules.
A bridge from zero revenue today towards potential revenue tomorrow.
Exactly. This $12.8 million, according to them, relates mostly to things like non-recurring engineering work, specific development projects they're doing for partners like VW's PowerCo subsidiary. Essentially, partners are paying them to solve specific integration challenges or conduct detailed studies related to using QS batteries.
Okay, so is this just clever accounting spin to put a positive number out there? Or does it represent genuine commercial validation?
I think it's more the latter, though you always have to be careful with non-GAAP metrics. While it's not revenue, it does show that major, serious partners are willing to put actual money down, write checks to fund QuantumScape's development work related to their specific needs.
So it proves the ecosystem believes enough in the tech to co-invest in its development.
Precisely. It validates that belief in a tangible financial way. It signals future cash inflows, even if they aren't product sales yet. And it shifts the story slightly from just, we are spending lots of money on R&D, to our partners are actually paying us to help get this technology ready. That's a powerful narrative shift.
Yeah, strategically, that's quite valuable.
Yeah.
Okay, so they hit milestones, they engage new partners, they introduce this billings metric. How did all this translate into their financial guidance for the rest of the year?
Well, that improved cost control we talked about earlier allowed them to tighten up and actually improve their full-year forecast. The expected adjusted EBITDA loss for the full year is now projected to be narrower between negative $245 million and negative $260 million. That's a smaller projected loss range than before.
Spending less than they thought they would.
Exactly. And capital expenditures, the money spent on equipment and facilities like that Eagle Line, are also expected to remain relatively low for the rest of the year, somewhere between $30 and $40 million. So the message is, we're spending less cash than we projected, but we're still hitting our key operational targets: discipline and execution.
Hashtag now for slide 5. The final narrative and market verdict. All right, let's bring it all together. Slide 5. We've covered the financials, the cost cuts, that amazing decade-long runway, the technical steps forward, the partner engagement. Let's try to synthesize this into the final story, the overarching narrative for QuantumScape's Q3 2025.
Okay, I think there are 3 main themes that really capture the quarter. The first one is that fundamental clash we keep coming back to. Operational execution meets market skepticism.
They did what they said they'd do.
They delivered, shipped the advanced B1 samples, managed cash brilliantly, hit their internal marks. But the market, which had already priced the stock for perfection or maybe even beyond, it wanted more. It wanted that huge transformative de-risking event that just didn't happen this quarter. So the solid incremental progress wasn't enough to sustain the hype, leading to that sharp sell-off as people took profits.
Okay, theme 1, execution meets skepticism. What's number 2?
Number 2 is the necessary cost of staying alive. Financial health is strong, but funded by dilution. That extended cash runway out to the end of the decade, that's monumental. It structurally de-risks the company's ability to actually finish its mission. That's huge.
Right.
But you absolutely cannot ignore the cost. That 15.7% increase in the share count over the past year, that's the direct price shareholders paid through the ATM program to secure that long-term stability.
So stability was bought, quite literally, with ownership percentage.
That's the trade-off, clear as day.
Okay. And the third theme?
The third theme is that subtle but important strategic shift, a strategic pivot to demonstrate commercial traction.
This is the customer billings thing.
Exactly. Introducing that $12.8 million customer billings metric. That's management being clever. They're leveraging the strong ecosystem engagement, the new OEM interest, the VW showcase, to build a financial narrative, a bridge.
Right.
It validates that key partners are actually putting money into the development effort, which helps build a story that leads from today's $0 revenue towards tomorrow's potential high-volume revenue.
Okay, so synthesizing those 3. Operational execution met skepticism. Financial health came via dilution. And they're pivoting to show early commercial traction. So if you step back and look at that clash of realities, Q3 2025 for QuantumScape feels like a textbook case, really. A company doing everything right according to its internal plan.
Milestones, managing cash.
But just crashing head-on into external market expectations that had simply gotten way ahead of the actual science and commercialization timeline. The operational team delivered, the finance team secured the future, the strategy team started building the bridge.
But the market's final verdict, at least on announcement day, was caution. Caution driven mainly by that high valuation and maybe a renewed appreciation for just how long and expensive the road to true mass commercialization still is.
So the technical progress, while real, was overshadowed.
It was overshadowed by valuation risk. It's a situation where even a technical victory doesn't guarantee a stock price win if the market has already priced in something spectacular and unconfirmed.
So wrapping it all up,
Yeah.
What's the final crucial takeaway for you, the listener, trying to make sense of these really speculative, high-growth tech stories?
I think this quarter really highlights a critical question you always need to ask yourself. Can you differentiate between execution risk and valuation risk?
Okay.
QuantumScape seems to be doing a pretty good job managing its execution risk, right? Controlling costs, hitting technical milestones, securing that runway. They're executing the plan. But this quarter, the market severely punished the valuation risk that high premium baked into the stock price. So when you're looking at these kinds of stocks, you absolutely have to weigh the tangible technical progress against the financial premium the market is charging. You need to understand that internal success, unfortunately, can sometimes be completely overshadowed by external expectations and valuation concerns.
That's a really important distinction, execution versus valuation. That 5-part framework we use today really does provide a great lens for trying to dissect a complex situation like this one at QuantumScape.
Absolutely. Now, just the necessary reminders. This report is for informational purposes only. It absolutely does not constitute financial, investment, legal, or tax advice. Any investment decisions you make should always be based on your own thorough research and due diligence.
And we should also mention, this report was generated by AI, integrating data directly from QuantumScape's official Q3 2025 earnings press release, along with publicly available market data and analysis.
That's right.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.